You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Mike, Janet Yellen gave us what? Positive news, neutral news? What happened today?
Well, basically nothing happened, but I did watch the news as it broke, and I think more interesting is what they're saying is going to happen. On CNBC, their head economics reporter, Steve Leisman, he was able to attend the press conference that came after today's Federal Reserve statement edict was presented to us. And it's interesting because in that conference room where she delivers the press conference, it's not a normal press conference like you see with the president, you know, a room full of people asking sometimes pointed questions. This is much different. In these Fed press conferences, she sits down at a table, never stands up, has a few pieces of paper in front of her, and there's just a few select people even allowed in the room, about 15 so-called reporters, and they're given pieces of paper too, with talking points on them. And all these people are carefully selected, and Steve Leisman is one of them. He's lucky enough to be one of these people. And they never ask critical questions. They just basically take the talking points, then get on television and repeat them. It's kind of almost like if you could imagine the Soviet Union back in those days, what the reporters, how they must have operated. It's sort of the same sort of thing. And these reporters defer so much to the Federal Reserve and her because, you know, that's the only way they can get in this room. So anyway, I always find his statements to be very important because it's sort of like a propaganda thing for us to know what we're supposed to know about the Fed. And what he said was that although nothing was done at this meeting, that in September the Federal Reserve may raise interest rates if and the word he used was a liftoff occurs in the economy and we reach a full employment. And he was suggesting that everything is on track for this to occur, and we're about to enter basically a liftoff is the word he used, where the economy will just grow and we're going to reach full employment by September. Well, for anyone that lives in the real world, these are really strange concepts because they don't really match reality. I don't know what they mean by full employment because I still know lots of people that are unemployed. I mean, I know that the official Federal Reserve or the official labor unemployment rate says 5.5%, but they just don't count so many people in those calculations. What they do to make that number is they actually take out anyone from the workforce who hasn't looked for a job in about 4 weeks. So you could be unemployed for 11 months or 12 months, and as long as you don't look for a job during the previous 4 weeks, you won't be counted. Well, you still don't have a job, and then these numbers don't reflect, you know, when they talk about all the jobs being created and how great it is, they don't reflect the fact that, you know, for the most part, these are low-paying jobs that have been created over the past couple of years. So the notion that we are somehow approaching full employment is really a fantasy, I think. And I think anyone, you know, unless you happen to live in one of the few areas that are booming, particularly around Washington, D.C., those suburbs are booming because of the growth of government we've seen in the past couple of years. Wall Street's boomed, but middle America, there's no boom. But they talk like there is on television. So I just wanted to remark on that. But the other thing about this is she did downgrade the GDP growth for 2015, and then she presented these predictions for huge growth in 2016 and 17. In essence, a liftoff they're predicting. But for anyone, I just don't think anyone should make any decisions based on these predictions, because we've been hearing this for 5 years, that the economy is going to boom next year and the Fed will raise rates. In 2010, the consensus was that of Wall Street economists was that the Fed would be raising rates in 2012. It was even more of a consensus back then for that to happen than there is now. And what we saw was the flash crash of 2010 in July, and then a new round of money printing operations to force the stock market higher. No interest rate hikes. They were all quickly taken off the table. So I think what we really face is the reality of an overvalued stock market that's been in a 6-year bull market, and all bull markets eventually come to an end. And this one, I think, is coming to an end because we're seeing fewer and fewer stocks, fewer and fewer sectors participate. Some diverge away and go into bear markets. And that's typically how bear markets begin, or the sign that one is approaching. And if the market just were to pull back 10% from its highs, any talk of rate hikes would just vanish. So I think that's the real situation. And today was just sort of like a political theater, just as the so-called journalism and reporting is pretty much a theater when it comes to these dozen or so people that pretend to be journalists in that press conference room. Now, so basically, I'm just trying to say I don't really think anything happened today. However, I think people need to be careful when it comes to the stock market. Sell, don't be afraid to sell, raise some cash of some sort. And I know, I've been saying that on your show pretty much from the beginning of this year. I've said several times people should just raise a 10% cash position, and have talked about, a bear market eventually coming, and the stock market really hasn't even done much this year but goes sideways. And, so I think most people are kind of not really even paying attention to it, or it's making them fall asleep. And when someone tells them they should do some selling, that makes them, kind of tune out too, because no one wants to hear that kind of advice. What people want to hear is how can they actually make money in these markets, not, I should be selling. Well, the one good thing about today's action is I do think there is money to be made now, because something significant, I think, did actually occur, and that is that mining stocks were up today just about close to 3%, or at least the gold stock ETFs, and they've been falling down for the past couple of weeks in a trading range. I think they've basically ended their correction, and they're in a position, if they break out of that trading range, which I think is very likely, to just take off and go into a new bull market. So if people want to actually start making money, that's the place I think they should look and buy some gold. Just as everyone, I think, should sell at least 10% of their portfolio for cash, I think they should have at least 10% of it in gold and precious metals, because I just think that's going to go up no matter what the stock market does. So there's kind of exciting stuff about what's happening.
We'll have more with Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, you said we've talked about the exciting stuff. So what's the stuff that we should ignore or walk away from?
Well, the biggest thing people need to walk away from is bonds, treasury bonds, because no matter what you think, every scenario is pretty much negative for them. I mean, if you think the Fed's right and you believe these predictions of an economic lift-off, and they're going to dramatically start raising interest rates, well, that means bonds are going to fall in value. However, I think they're going to fall in value even if they don't raise interest rates, because I think we've seen a huge bull market in bonds, a world bull market in bonds, and I think it came to an end in the first quarter of this year when we saw the European bonds go up so much in value that some of the government bonds in Europe are paying negative interest rates. And the yield, for example, on a short-term German bond got down to like 0.25 or so, and now it got up close to 1% last week. So what that shows you, I think, is we've seen that bubble sort of top out, and I think the overall direction for bonds over the next couple of years is going to be down. So that's, I think, the number one thing people really need to avoid. And it makes no sense anyway. You know, who wants to buy a bond and lock their money up for 10 years and just make, 2.5% or something on it? Who wants to buy a CD and make even less than that? So, if you got CDs and they come due, I wouldn't put it back in any more of that stuff, especially if gold goes up and silver go up. What that's going to mean is that inflation is eventually going to come to the forefront and be higher than these little things, return you get on your CDs. So bonds are the number one thing to avoid. I think stocks as a whole people need to be very careful with, but the bonds are really the thing that people shouldn't just be careful with, but run from.
Do you have any outlook on crude right now?
Yeah, crude oil is something I'm watching very carefully. I'm not buying it right now, but I think that probably next year we should see a good bottom there, or it may not even fall much more from where it is, but I don't think it's ready to really go up in any sort of sustainable bull market, but I think it could next year. Typically, after you see a big drop in any market, it takes a period of time to recover and build a base and prepare to go into a new bull market. I mean, if you look at gold, it's basically been basing for almost 2 years now. So that's a long time, but you expect to at least see something based for a couple months. So I think it's best to be patient with the oil, but more importantly is inside the futures market about a year ago, something dramatic happened. And that is that before oil even started to drop, commercial players, and you can analyze this or get this data if you go to type Commitment of Traders Report in Google, but inside the futures market, commercials and giant hedging companies, they built for themselves the largest short position in the history of the oil market. And these guys tend to be right at key tops and bottoms in a market. So they were positioned to make money when oil dropped, or at least hedge their operations. And of course, we know what happened. Well, once oil started to fall in around October, November, December, we then found out, it became public news, that Saudi Arabia was increasing the oil production. They wanted to see oil fall, and they were doing two things. One, they wanted to see the ruin of American oil fracking companies. They wanted them out of the market and eliminated, so they didn't want to compete with them. And they also seen, there's hints of this, that they wanted to lower the price of oil to give Putin and Russia a hard time because they make a lot of money from the oil market. And they were doing that in league with the United States government. So it's kind of crazy. On one hand, they're hurting the American oil companies, and on the other hand, they're helping the people inside the United States government who want to hurt Russia. It's just how crazy politics get. But the important thing is that those giant short positions have only been about halfway covered. And when they started in December, when this news started coming out, there were projections that it would basically take a year and a half to devastate the American fracking companies and force many of them to go bankrupt. So it kind of gave you a good idea of a time frame. And now they've only covered about half the short positions, and, it's been about a year. So I really think we're looking at another year before we really see oil go up, because I don't think the Saudis are going to let it go up. They're doing an operation, and I wouldn't try to bet against them. They're still carrying it out.
Mike, thanks a lot for chatting with us.
Thank you. It's great talking with you.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.